again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is the 6th of January, 2022. Markets are moving. What we're paying attention to, so you should be too. Thanks for watching. Before we begin today, I want to bring up a very important point. When asked our thoughts on the market, what we don't do at Blanke Schein Wealth Management is spend time making predictions. But what we do, as you've seen in my daily updates or even my most recent media appearances, is we communicate very important ideas that we're vetting from our research, what we're paying attention to. And it would be a cause and effect. So we're prepared for the future by way of what's important, what the markets are paying attention to, what we're paying attention to, what our research is telling us, how we're going to position appropriately and accordingly. Because what we do know is, as I talked about earlier this week, this is a recap of what I had on earlier this Tuesday. Earlier this Tuesday, I talked about the bond market volatility, NASDAQ sell-off, and that's a result of rising in interest rates. And the rising of interest rates on Tuesday was anticipatory of what happened yesterday, which was what the Federal Reserve actually released their minutes from their December meeting. Now, if we go back to when I was on Yahoo Business reporting, the last week of December, the newscaster asked me to make a prediction, and I said, you know what I'm paying attention to, what markets care about most, and in that interview, I specifically brought up the point that markets are going to care about January 5th, the minutes from the Federal Reserve. And what did we get yesterday? January 5th minutes, and the market reacted. And it was a negative reaction because we didn't know what was in the minutes. What we knew was very important. It was the language of what the Federal Reserve or the discussions behind closed doors really was, and why it caught the market off guard at that moment in time yesterday. And markets traded down, all risk assets traded down as a result, simply because behind closed doors, what the Fed minutes really said that in current financial conditions, meaning the economy is extremely strong. The U.S. economy, if you look at the labor market's extremely tight. You could find a job if you want a job. If you look at housing, it's up. All assets are elevated. They said that in previous episodes, meaning previous times at the Federal Reserve, when they've had all these accommodations, we have so much money. We have $2.35 trillion globally, but in the U.S., you had a bunch of, 5 different stimulus programs and quantitative easing. So in previous times, when markets or financial conditions were solid in the U.S. economy as they are today, the Federal Reserve has moved quicker in raising interest rates, and they've moved stronger in terms of pulling back all of the liquidity, and in this case, it'd be global liquidity because the rest of the world is growing. So interest rates are going up. In fact, we even talked about this on Tuesday. The 10-year Treasury, what to watch. I put this on the board. On Tuesday, we were at 146 when I filmed this. And then right now, we're at 164, Right now, we're at a 1.72 as we're filming. We'll see if we close, the 10-year Treasury closes above this. Now, again, it's not a prediction. It's what our research is showing us and what we're reading and basically our due diligence is showing as to what is important for markets and how sensitive markets are to key figures. So I point your attention to the 170 handle on the 10-year Treasury, and that's an important factor because it shows that, one, interest rates are rising both here and globally. If you look at the German Bund, the 10-year Treasury in Germany, it's now close to positive, which means if interest rates rise, what is that telling us, Rob? Well, really, it means that there's an economy that is healthy. That's an economy that's growing. We're going to hit $20 trillion on the GDP this year. We're not going to grow as much as we did last year because we had all the stimulus. So our rate of change is going to change. We could see above 3% plus or minus on the growth rate. At least that's what projected. Again, it's not a prediction. That's just what the economists are saying. But we're going to pay attention to the U.S. economy is growing, and that's incredible from what we've seen over the last 20 plus months. The U.S. economy is growing. It's growing globally as well. The growth is going to be more muted than it was this last year in 2021 than in 2022, and that's to be expected. Now, that's because interest rates are going up. They're showing us that the economy is rising. And now the question is, behind the scenes, is the Federal Reserve behind the curve? Meaning, and that's what the markets really said, behind closed doors, the Federal Reserve was very hawkish, meaning they're very, if it's one of my kids, you're not going to go to the dance on Saturday night because you're grounded because I just saw your report card, right? And then what Jerome Powell, the Federal Reserve Chairman, did publicly is more of a softer tone. He basically massaged the whole conversation and said, very, very buttoned up and very calculus. The calculus on what he says is very important. So that's sort of the mismatch that we got yesterday, and the volatility will continue today, and we're seeing that in today's trading. But as one of my daughters or, come to me and say, listen, I'm going to work on my grades, but I really want to go to the dance on Saturday night, and I got the dress and mom took me to get the shoes and all this, it's really going to come down to, yes, I'm probably and more than likely, our daughter is going to go to the dance on Saturday night. And that's the disconnect that we're going to get. You're going to get the hawkish tone and you're going to get the dovish reality is really what we're going to see. So markets have to work through that. And the reason why markets are so volatile is because you're pulling away the stimulus, the 1.5, the $2.5 trillion stimulus globally. That's a big deal, right? And that's going to create more volatility, as we're going to see. Now, what's next? What we're going to pay attention to on the front end on a go-forward basis is, yes, we obviously looking at the 10-year Treasury where they close. If it closes above 1.7%, that just means it's more volatility to come if that happens. And then we're also going to look at if markets continue to sell off, do we test the 50-day moving average? Remember, if you're following at home, I did this in fact, right after December 15th, a couple days after the S&P finally tested the 50-day moving average, which again is at the 46.67 level as of today. And so if it does and it holds, that means that we have a rally that's still in good standing, if you will. If it doesn't, then we react. Again, we have cash on the sidelines for our clients at Blanke Schein Wealth Management. So we're positioned either way. And that's what we use the guide rails. We use all of this intel, if you will, and it really bakes into our calculus as to how we manage the volatility for our clients and take advantage of opportunities as we see them come their way. Again, the predictions are only as good as somebody says, but what we really pay attention to is what markets are paying attention to. And that's what's really important, because that's when you can take advantage of what's to come. So that's a little update for us on our daily update for Blanke Schein Wealth Management. Thanks for watching.